Every company we've covered in this series so far sells equipment. A big machine, a fab buys when it's expanding. Applied, Lam, KLA, the testers, the bonders. They sell razors. Today's company sells the blades. Entegris doesn't sell a machine. It sells the filters, the ultra-pure chemicals, the gases, and the polishing slurries that get used up on every single wafer run.
And that one difference changes everything about the shape of the business. Because if you sell the razor, you get paid once when the fab is built. If you sell the blades, you get paid again and again every time a wafer runs through the line for the entire life of the fab. That makes Entegris the lowest cyclicality, most recurring way to own this whole memory build-out. Let's unpack it. Disclaimer first. One small thing up front. We genuinely love these companies as stories, but we're explaining them, not recommending them.
So treat all of this as food for your own thinking, not financial advice. Stay curious, stay a little skeptical, and make your own calls.
Quick and clear. Education and entertainment only, not investment advice. Entegris is a public example to teach this layer, never a recommendation. No buy or sell calls, no price targets. And a specific note for this one. Its headline price-to-earnings multiple is unusual, for a reason we'll explain, so don't read it the way you'd read the others. Verify everything live. Do your own research.
The one-liner for Entegris. It's the recurring, qualification-locked consumables annuity of chip making, lower beta than the equipment names, and arguably earlier in its own recovery. But, unlike the others, it carries real debt. Those three pieces, recurring, earlier, indebted, frame the whole episode.
And qualification locked is the magic phrase we'll come back to. It's the reason a consumables business, which sounds like it should be a commodity, actually has a deep moat. Hold that thought. Here's why a consumables company belongs in a memory expansion series. It rides two compounding tailwinds at once. First, more wafers. Doubling memory output means more wafer starts, which means more filters, more chemicals, more slurry consumed every single run. That's recurring, not one time.
And second, more content per wafer. Advanced nodes and HBM and 3D stacking add process steps, new materials, stricter purity requirements, and a lot more polishing, because stacking layers demands they be perfectly flat. A leading-edge or HBM wafer consumes several times the Entegris content of an old legacy wafer. So Entegris rides both the quantity of the memory wave and the intensity of it, and it gets paid no matter which memory maker wins. It's the purest own the inputs name in the series.
And put a number on that content per wafer idea, because it's the heart of the bull case. Industry estimates put the materials and consumables content of a leading-edge or HBM wafer at several times that of a mature node wafer. More deposition steps, more unique chemistries, more polishing passes, tighter filtration. So even if total wafer units grew slowly, Entegris' revenue per wafer would keep climbing just from the mix shifting toward HBM and advanced logic. That's a second engine, independent of the raw wafer count.
A little history. Entegris was founded back in 1966 near Boston in microcontamination control. Basically, keeping the fluids and gases inside a fab impossibly pure. It grew organically and by acquisition into a broad consumable supplier across the whole fab flow.
And the transformational and complicating move was in 2022. It acquired CMC Materials, the leader in chemical mechanical polishing slurries and pads, that turned Entegris into a genuine consumables powerhouse. But it also loaded the balance sheet with significant debt. And that debt has been the central overhang on the story ever since. So you can't understand Entegris today without understanding that one acquisition. It made the franchise, and it made the risk. 4 pieces roughly. Microcontamination control, the filters, purifiers, and membranes that guarantee purity. That's the historic core. Specialty chemicals and engineered materials, the deposition precursors and advanced chemistries. Advanced materials handling, the containers, valves, and dispense systems that safely move critical materials around the fab.
And then the polishing business from that CMC deal, the slurries and pads that planarize each layer. And that last one is more memory relevant than it sounds because HBM and 3D stacking are intensely polishing dependent. Every one of those many stacked layers has to be made perfectly flat before the next one goes on. So the CMC acquisition didn't just add scale, it added direct HBM leverage. The technology thread is purity and planarization, embedded everywhere. On purity, Entegris removes nanoscale contaminants from the chemicals and gases, and at advanced nodes, a single molecule of contamination can scrap an entire wafer. So this isn't a nice to have, it's yield critical.
And on planarization, those layer-specific polishing chemistries, which get more critical with every stacked layer of HBM. The unifying point is this. Entegris content isn't bolted on at the end. It's embedded in the recipe. It's qualified per fab, per process, per individual layer. And that word qualified is the entire moat, which is where we go next. Run the 3-question screen. Question 1. Real bottleneck? Entegris is top 3 or oligopoly in contamination control, filtration, specialty materials, and polishing. But the real moat isn't share. It's qualification switching costs. Its products are tightly specified and qualified into a fab's exact process. To switch suppliers, a chipmaker has to requalify, which means process risk and potential yield loss on a multi-billion-dollar line.
So customers are extraordinarily sticky. Nobody rips out a qualified consumable to save a few percent, because the downside, a yield excursion, dwarfs the savings. Question 2. Does the next architecture help? Yes, more steps, more materials, more purity, more polishing, plus advanced packaging chemistry. And question 3, can customers keep paying? This is where Entegris scores highest in the whole series, because it's tied to wafers run, not just fabs built. It keeps earning straight through a CapEx pause. Let's make that concrete, because it's the single most important number on the name. Roughly 75% of Entegris revenue is unit-driven. It tracks the number of wafers actually produced, the fab utilization. Only about 25% is the CapEx-driven, equipment-style part tied to new fab builds.
And you saw the model work in 2025. The unit-driven part grew a couple of percent, while the CapEx-driven part fell around 7%. So while the equipment-style portion dipped with the cycle, the recurring base held the company up. That's the definition of own through the cycle. It's the same idea as KLA's contracted services, except Entegris is entirely consumables, not equipment. The blades keep selling even when nobody's buying new razors.
And that 75-25 split is the number to anchor on because it's what separates Entegris from everyone else in this series. The equipment names are nearly all CapEx-driven. They live and die on the fab build cycle. Entegris flips that ratio on its head. 3/4 of its revenue tracks the steadier rhythm of wafers actually being run. So its revenue line is visibly smoother through a downturn than Applied's or Lam's, and that smoothness is the investment case.
The financials? Revenue around $3.2 billion last year, roughly flat, with gross margins around 44% recovering toward 47%, and free cash flow around $400 million and improving. Solid, recovering, not spectacular.
And notice those margins, around 44%, are below the equipment names. Applied and Lam are near 49%, KLA at 62%. That's just consumables economics. Blades carry lower margins than razors. So the trade you're making with Entegris is explicit. You give up some margin and some operating leverage, and in return, you get much lower cyclicality and a recurring revenue base. Lower ceiling, higher floor. Now the single biggest risk, and we have to be direct about it, debt. After that CMC acquisition, Entegris carried net leverage around 3.8 times EBITDA at the end of last year, and it's targeting below 3.5 by the end of this year. Paying down debt is a higher priority than growing the dividend, which has been flat since 2022.
And debt is a double-edged thing here. On the downside, in a recession or a delayed recovery, leverage magnifies the hit to the equity. That's the real danger. But on the upside, if the cycle recovers and margins and cash flow inflect, then deleveraging itself becomes a powerful tailwind, debt falling while earnings rise. So the balance sheet is simultaneously the biggest risk and one of the bigger upside levers. Which one wins depends on the cycle.
And to make the deleveraging concrete, every dollar of debt Entegris pays down lowers its interest expense, which flows straight to earnings, which lowers leverage further. A small flywheel. Management has been explicit that paying down debt outranks buybacks and dividend growth for now. So a patient owner is really underwriting two things at once: the memory recovery, lifting the top line, and the balance sheet quietly healing underneath it. Both have to go right, but they tend to go right together.
And now the valuation, which is genuinely the most interesting in this series, because it's the inverse of Applied and Lam. Entegris trades at something like 90 to 100 times trailing earnings, which sounds insane. But here's the catch. Those are trough earnings, depressed by the soft capex, compressed margins, and the interest expense on that debt.
So this is the mirror image of the equipment names. Applied and Lam are a low multiple on peak earnings, which is the dangerous quadrant if the cycle rolls. Entegris is a high multiple on trough earnings, which means if the cycle recovers and margins and cash flow inflect and the debt comes down, the earnings re-rate up and that optical 90 times normalizes. So the discipline is, don't read the 90 as expensive the way you'd read Applied's 50, but don't read it as cheap either. The debt is the catch. The honest way to judge Entegris is on enterprise value to EBITDA and the deleveraging path, not the headline PE. On competition, it's an oligopoly, but with real rivals. In specialty chemicals and materials, there's DuPont, Merck, Air Liquide, Danaher, and various Japanese and European niche chemical makers. And interestingly, one of its competitors in materials is MKS Instruments, which is the very next and final episode in this series.
Entegris's edge is breadth and qualification depth across the entire fab flow. It's not the best at any single chemistry, but it's qualified into more of the recipe than anyone. The risk on the other side is price pressure from big customers and dual sourcing. Chipmakers deliberately qualifying a second supplier to keep Entegris honest. So the moat is real, but it's defended every day.
And it's worth being honest that breadth cuts both ways. Because Entegris spans so many chemistries, it's rarely the outright technology leader in any single one. A focused rival can out-innovate it in one niche. Its bet is that integration, being the qualified, one-stop supplier across the whole flow, is worth more to a fab than being best in class in any one slot. That's a genuine edge, but it's a different kind of edge than a pure monopoly like Lam's edge.
Briefly on geopolitics. China is a notable slice of revenue, and export controls cap how big that can get. But Entegris's response is pragmatic. It's localizing production to Asia, aiming to supply the large majority of Chinese demand from within Asia to dodge tariff and cross-border risk.
And the key point is that China is a less acute problem for Entegris than for the equipment names. Consumables are less in the crosshairs of the most advanced export controls than the leading-edge tools are. It's a managed overhang, not an existential one, which fits the broader profile of Entegris as the lower drama, lower beta name in the group. Both cases, plainly. The bull. The recurring razor blade model, utilization-tied consumables are the lowest cyclicality way to ride the memory wave, and they keep earning after the build. Rising content per wafer at advanced nodes and HBM, the recovery plus deleveraging optionality off trough earnings, and the sticky qualification moat.
The bear? The debt. 3.8 times leverage is the magnifier if the recovery stalls. Lower margins than the equipment names, so less operating leverage. China and customer price pressure, and the fact that it is still cyclical, just less sharply, while that optical 90 times multiple offers no visual cushion if earnings don't inflect. A quality recurring business with a balance sheet asterisk.
So the net read. Entegris is the own through-the-cycle enabler, the lowest beta, most recurring way to ride the memory wave, scoring highest of the whole series on the can customers keep paying question. Of every name we've covered, Entegris and KLA are the two quality compounders you'd most want to hold through a 2027 overbuild. KLA via process control intensity and services, Entegris via the unit-driven consumables annuity. Entegris carries more debt risk, but offers more recovery and deleveraging upside.
And its valuation setup is the inverse of the equipment heads, a high multiple on trough earnings. So it's earlier in its own recovery and, by some measures, less chased. We don't predict. We test the thesis as the evidence lands. Next episode is the finale of the whole series, the subsystems. MKS Instruments and Advanced Energy, the picks behind the picks. We've actually done full standalone deep dives on both of those already. So we'll build on them, place them in the map, and then rank the entire enabler stack top to bottom. Thanks for spending part of your day with us, and tell us, in this build-out, would you rather own the razor or the blades?
That's a wrap for today. Thanks for thinking it through with us. We're just testing our theses out loud, one day at a time.
Catch you on the next one. Stay curious and tell us where we're wrong.